We've seen used car prices start to normalize. They've come down over the last 12 months, but they're still not at pre-pandemic levels. Interest rates have skyrocketed. So I think consumers are trying to hold on. They know it's hard to get a car. Financing is going to be more costly. So they're sitting in this perpetual delinquency, but not letting the car roll to loss.
What's up, everyone? This is Car Dealership Guy. You're listening to the Car Dealership Guy podcast, which is my effort to give you access to the most unbiased and transparent insights into the car market. Let's get into today's episode. Betty Jotanovic is the president of Chrysler Capital and Auto Relationships at Santander. In this conversation, we discussed how Santander predicts auto loan defaults, the rise of 96-month loans, the challenging vehicle affordability landscape for consumers, solving for EV and auto loan fraud risks, rising defaults, repos, and much more. But before we get into the show, this episode is brought to you by Auto.fi. Most digital retail platforms are limited in their capabilities and fall short on empowering dealers to convert shoppers into buyers while protecting profitability. Auto.fi delivers done deals by empowering your dealership with the technology to land customers on the right vehicle and deal. From payment configuration, F&I product selection, credit, and real-time lender offers. Plus the back-end selling tools to help close the deal. This accelerates the deal no matter where the customer is, on the dealer's website, over the phone, or in the showroom, and translates to a faster sale with better customer experience and higher profits. In fact, the most engaged dealers on Auto.fi see $411 more back-end PVR versus non-Auto.fi deals. Go to autofi.com/CDG to learn more or click the link in the show notes below. That's autofi.com/CDG and start working with done deals today. This episode is also brought to you by Podium, the lead conversion platform for car dealerships. Podium helps you get found at the top of Google search and convert new leads faster with industry-leading communication tools and AI. With Podium, you can finally take the guesswork out of lead management, bring every lead into one unified inbox, respond automatically in 2 minutes or less, and even book appointments using AI. Get Podium and get ready to convert leads faster than ever and see why over 100,000 businesses like yours have given themselves an instant advantage with Podium. Get started today with 10% off your plan by texting Car Dealership Guy to 833-441-1166. That's 833-441-1166. Text that number and mention this podcast to get 10% off your plan or visit the link in the show notes below. All right, so tons of demand, requests, desire from the audience to get an insider's perspective into what is happening with lending, the economy, auto finance. You saw I made a post. I made a post yesterday about what is going on, all these buzzwords, right? People talk about it all the time. It's in the media, it's on social, but what's really happening? So I think it's great to have you on so we can dive into that. Before we get started and we get into the nitty gritty, can you give us your background and tell us how you got to Santander? Or did I say that right? Is it in the car business? There's 3 ways to say it: Santander, Santander, and Santander. So that's the classic saying in the car business.
Yeah, you said it the right way, but I found that whenever I do say it the right way, Santander, sometimes I have to say it 3 times. And when I finally say Santander, everyone's like, oh, Santander. Okay. But yes, you said it right. So I have been in the auto business since 1994. Love the auto business. Born and raised in Detroit. I started actually on the assembly line at Chrysler Motors. I was going to law school at night, and I worked the midnight shift putting nameplates on Jeep Grand Cherokees at the Jefferson North Assembly Plant. So in my career, I have worked from the beginning to the end of the life cycle of a car, from when it's built to when it's charged off and then packaged and sold in a debt sale. I started my white collar professional career at Chrysler Financial. So from the assembly line, did that for little less than a year. And then I got a job at Chrysler Financial working in treasury, worked the cash desk. And then after I graduated law school, I worked in the tax department, did that for a bit. That's kind of where a lot of lawyers in the company landed. But then, I really enjoyed the business side, the less stuffy, not that tax is stuffy, but it really wasn't my personality. So I ended up doing a rotational program where I did a project for our, at the time, head of sales and credit. So I was essentially like his chief of staff. After I completed that program, he hired me to be his chief of staff, worked in sales and credit. And then, as everyone's familiar with the Chrysler bankruptcy and the split from Daimler, they reassigned leaders. He worked on the collection side. So that's how I got my experience on the back end, moving over with the executive that I worked for, and then spent the better part of a decade working in collections. I went to Bank of America, where I ended up running the collections, customer service, remarketing, and recovery. And then ended up also at Bank of America on the front end, doing the credit, funding, dealer management. And then that role is really what brought me to Santander. They were really looking for someone to come in on the front end of the business. And as the company grew from a startup and matured into a large regulated financial institution, they, believe it or not, it wasn't my Chrysler financial experience that brought me over to Santander. It was the fact that I worked for a big bank. I had a background in legal and, really just to help put the governance and controls in the business, which was a big focus the first couple of years I was here. And then last year, when Bruce Jackson, who previously held this role, was promoted to CEO of the auto business, I took an expanded role where I took on the sales team and the commercial team, in addition to my credit and funding and dealer management responsibilities. So,
all right. So for anyone listening and doesn't quite understand, you're the president of Chrysler Capital, but also the head of auto relationships at Santander. How does that work? Explain this to the audience.
So my role is essentially the front end dealer facing business. So Chrysler Capital is a distinct business that we have, and we go to market as Chrysler Capital. But we also have auto relationships with other brands. We have a network of about 14,000 dealers across all OEMs. So the auto relationships piece is everything but Chrysler Financial or Chrysler Capital. And so Chrysler Capital is its own separate white label channel.
Got it. So, and why do they need you, right? Like if I'm Chrysler or if I'm whoever, some car manufacturer, why do I come to you and say, hey, let's set up, a lending arm together? Like what value are you bringing? What do they bring to the table? How does that work?
So, from my perspective, it's a couple of things. It's one, having a partner that has expertise in lending. Manufacturing is very different from lending. It allows you to focus on that business. But I would say, the other piece is really being able to not have to deal with the regulatory side of it. I did spend about 4.5 years at GE Capital. I stepped away from the auto business. And one thing I learned when I was there, it was GE is a manufacturing company. And back in 2015-16, they decided to start divesting a lot of their capital business. And the rationale was it was so highly regulated that it took a lot of focus away from the manufacturing side. So, I think when you think of auto financing, it's very highly regulated, very consumer focused. And so, you do have some OEMs that want to have a wholly owned captive, but they've built that expertise within their shop, within their company. But where you don't want to deal with that noise and you want to focus on the manufacturing, you have a captive, they have the expertise, they can help build programs, drive financing, help you sell your product. It's a complementary service, but also, not have to deal in the weeds with some of these complex issues that may not affect manufacturing as much.
Yeah, look, it makes sense, right? It's not their core competency. So in concept, it makes sense to me. Not from this world at all. And it's just interesting, why they would seek you out and what value you bring to the table. So that's helpful. Now, and then other than Chrysler Capital, are you a captive for anyone else or any other car manufacturer out there?
Yes, we just had our 1-year anniversary with Mitsubishi in May. So we do that business. And then we just recently announced partnership with Lotus and with Ineos.
So if I go right now to buy, I actually tweeted about Mitsubishi's the other day. I was tweeting about the 7-passenger Outlanders. I don't know if how familiar you are with those, but they're pretty hot. They're pretty hot sellers for their price point. Anyway, so if I go buy one right now from a Mitsubishi dealer and I finance it through Mitsubishi Financial, so that's you actually on the back end.
Yes, and so for Mitsubishi, we do it through the Santander brand. So there's not a separate branding there, but we are the preferred lender. And so any subvention would come through us.
Got it. Now, transitioning to dealers for a second, right? You have a massive, massive portfolio of just dealer business. What's the number you mentioned? Like
14,000.
14,000. Got it. So is most of your business today, is it actually being originated from independent dealers, or is it, through these captive arms at franchise dealers? Like, how does that work? What's the distribution there, or whatever you can share?
It's primarily franchise dealers. So obviously, Chrysler, and then our other OEM partners, Mitsubishi, Lotus, and Ineos. But along with all of our other dealers, any OEM. So we will have Ford and GM and Kia and Toyota, you name it. We do all the OEMs. We have a very small portfolio of franchise dealers. We have stringent requirements just because of the risk associated with that. But we do have a pathway for franchise affiliates. So if you're affiliated with with a franchise dealer that we do business with, there is a path to do business with us, but the requirements are just a lot more stringent.
Yeah, like, being from the independent side, Santander is like a tough lender to sign up with as a dealer. Like, I can tell you, like, I've been there, and that's the reputation on the street. It's tough to get. Why is that? Would you say, like, why do you have a tougher reputation to sign up with new dealers in the market?
Yeah, and I think that's changed, the last several years, with our evolution. As I mentioned, it was a very entrepreneurial startup type of company. And then when Banco Santander purchased it, obviously we had to be held to a much higher standard of operating, a lot more regulatory scrutiny. We deal with all the regulators, from the Fed to the CFPB to the OCC, as well as we're subject to regulation by the 50 states. So there's someone always, looking over our shoulder. Aside from that, it is the right thing to do. We want to make sure that we manage the risk in our business. We want to make sure that we're doing the right things for our customers. And so we do have a very stringent vetting process to make sure that the dealers that we do business with are reputable. And that just makes our job a lot easier because we're very focused on doing the right thing for the consumer, ensuring no customer harm. And it just makes our job a lot easier if you're dealing with reputable dealers. And there are a lot of them out there.
I'll give you kudos. We went through the sign up process. I mean, not too long ago, and it was intense in a good way. I mean, things went well, but you could tell that your team definitely does their diligence. So kudos to you on that, because I don't think every lender can attest to that. So I guess on the topic of dealers, while we're at it, from your perspective, like, what do you actually seek in a dealer, or like what makes an excellent dealership for you to work with?
For us, we're looking for a partner. We're looking for, a dealer that wants to have a mutually beneficial relationship. We want to see quality and volume. We're traditionally known as a subprime lender. That's where we got our start. But with the Chrysler Capital relationship, we obviously are a full spectrum lender. We do lease, we do retail, we do small business, commercial, floor plan. So we want a dealer that is going to leverage all of our capabilities, send us a wide spectrum of volume and quality of volume.
If I'm understanding this correctly, are you starting to expand away from subprime? Not saying that you're not doing subprime anymore, but are you looking to like move upstream and additionally, or like what's your thought there?
Absolutely. We're a full spectrum lender, and we have been doing prime. Has been historically under the Chrysler Capital brand is what the market has seen. But we are and have launched it under the Santander brand. So, we have that capability to do prime as well as subprime and all the other products, lease and commercial as well.
So, like hypothetically speaking, if I was in that boardroom where you're, talking about kind of moving upstream, how are you like, what's your strategy to compete, right? Because the marketplace is efficient. There's plenty of lenders that are operating in the prime segment. How are you going to compete in that segment? Like, how do you think you can actually gain market share there? Whatever you can share on that.
So I think that the top prime segment is always going to be very competitive. You've got your big banks out there. I spent several years at Bank of America, they're a top prime lender, and that's where they play. Um, and the margins are very thin. So it may not be worth it for us to get super aggressive and fight for that top prime business, but we think there's a place for us, right behind that top prime. Maybe we're not, the best price there, but when you start getting a little bit lower in the food chain, in that prime behind the top prime, as well as in the near prime segment, that's where we excel, and that's where I see we have a place. And then I think where we really fit is, if we're in that room with the dealer and the customer, and maybe, Bank of America, Chase, Wells, you name your bank lender, maybe they don't approve it, but we do as a tier 3, and we come right behind them. I think that's our advantage, where if a prime lender won't buy it, or maybe they're not as competitive, we're willing to, to go a little deeper, and we know how to price in that near prime space.
Yeah. So my super simplistic brain thinks that in order to be the most competitive in your field, you have to be the best at predicting risk, because the better you can predict risk, the better you can price the collateral or the loans. So what is, and look, I get these things are complicated algorithms and whatnot, but like, how are you quantifying risk? Obviously not other than credit score. Like, what is there, like anything specific that you look for that's different than other lenders? Like, how are you going about that?
Yeah, we have a proprietary model that we've built, and it'll look at historical performance with us, on us, off us. We obviously use the standard tools in the market to identify fraud, but we have a heavy reliance on a lot of elements I can't share that are proprietary. But I think that's kind of our secret sauce, that we have experience in segments that other lenders may not, and so that's our competitive advantage.
I want to zoom out for a second. Like you've seen a lot. I love that you worked from like, the manufacturing, on the floor all the way through the supply chain to the top. It's really, really admirable. Tell me a little bit about like the current just state of the union right now with respect to the economy. Like we'll get into more, specifics, but I'm just curious, like what's going through your head nowadays, like what's keeping you up at night with respect to like auto loan performance, the broader economy and everything to do with that?
Yeah, I think, when you look at performance, we all enjoyed the best of times during the pandemic, where we had, 0% financing. There were cars available. Consumers were flushed with cash between stimulus and then, not spending money on gas to go to work, and not going out to eat or going on vacation. So we enjoyed a lot of good times in terms of originations, as well as, the performance of the back book. What we're seeing now is kind of a return to normal. From a delinquency perspective, we're seeing a return to almost pre-pandemic levels. But when you look at the actual losses and charge-offs and repos, those aren't quite there. So that kind of tells
how do you reconcile that? Yeah, how do you reconcile that?
That tells me that the consumer is strained. We've seen used car prices start to normalize. They've come down over the last 12 months, but they're still not at pre-pandemic levels. Interest rates have skyrocketed. So I think consumers are trying to hold on. They know it's hard to get a car. Financing is going to be more costly. So they're sitting in this perpetual delinquency, but not letting the car roll to loss. And so, that concerns me. When we talk about the back book, when we look at originations, you've got the same dynamic of affordability. Car prices have skyrocketed. Interest rates are up. General inflation is just putting huge pressure on the consumer's wallet. And so it's making it harder for the average consumer to buy even a used car, let alone a new car, which has almost become out of reach for, the average American.
Yeah. What do you think the end game is here? I mean, do you think just like, financial products have to evolve to meet the modern day consumer and car prices? Or, do we see like deflation on car prices? Like, what do you actually think happens here?
Yeah, that's tough. I think, we're going to have to see some lower cost options in the market. We've seen new car prices skyrocket because of the options. And especially now with the shift to EVs, there's a lot of R&D costs that has to be moved on, priced into the cost of the car. I think we're going to have to see some lower cost options for consumers. And I know a lot of OEMs are looking into that and creating the right product that consumers can afford. And that's on the new car side. When we think about the used car side, we're still, I think we're still grappling with a bit of a supply challenge. And so once we start to see that supply normalize, only then can we see some relief. And then, in terms of the interest rate environment, that just makes it even more challenging. So we're going to have to see some changes there. You mentioned financing options. I don't know that extended terms are the answer. I think it's a short-term solution where you can bring a payment down, but longer term, it's going to create challenges for the consumer. If they can't otherwise afford the car, extending that term to me is just kind of prolonging the inevitable, potentially putting them into a negative equity position down the road. So that, that may not be the solution.
Yeah. Do you see, on the topic of extended term, do you see a future where like 96-month used car loans are just like a common everyday reality? Do you think that's viable and likely to happen?
Yeah, that's tough. And we're very rigid with our extended terms. Only 12% of our portfolio is 73 to 75 month. Only 2% is over 84. And where we do offer the extended terms, it's typically going to be a prime customer. We want to make sure that the customer can afford the car. Contrary to popular belief, we don't want a customer to default. We don't make money when a customer charges off or is repoed. So it's very important for us and the customer to assess the affordability up front. So when we do offer an extended term, we're going to make sure that there isn't layered risk, such as high LTV, high mileage on a car, really a unit or a borrower that really shouldn't qualify for an extended term. So, I think 96-month terms, it may be a solution for a customer that can otherwise afford the car and by choice wants to, maybe reduce the cash flow impact. But I don't think it's a solution where we're going to put customers into cars they can't afford and just spread it over a longer term. I don't think it's right for us or the customer.
You mentioned something that, like, is that really a misconception that you benefit when someone gets repoed? Is that like a misconception out there?
It absolutely is. Our goal is to work with the customer, keep them in the car. We've got stringent requirements up front in terms of assessing capacity to repay. We want to make sure the customer can afford the car. And then from a servicing perspective, we want to do all that we can to work with the customer and help them to stay in that car. That's why, we do have an active outreach program and we encourage our customers to work with us when they are coming across challenging times.
One thing that I've learned in this business is that one of the best ways to mitigate repos and, also help you as a dealer with your portfolio in the long term is simply, simply, it's, easier said than done, but properly reconditioning the vehicle. I think the stats are like, 50% of repos or something like that are from customers where subprime customers where the vehicle like broke down or they can't afford repairs. I think, you can correct me if I'm wrong on that, but what we saw is that, just properly reconditioning it, then of course, being reinsured as a dealer, meaning you are your own captive. You're providing your own captive, vehicle service contracts to your consumers, right? Where you're actually profiting from the underwriting profit or loss. Anyways, very wordy, but the long story short being that it was tremendously helpful in reducing just loss ratios throughout the portfolio because, you invest a little bit more in that car, make sure that the consumer is not, it's, as much as you can, it's a machine, but as much as you can, that it's going to last them a while, maybe even give them a little, coaching, again, as much as you can on maintenance. It's not always perfect. It's far from it. Lots of people don't listen. Lots of people don't care. Lots of people don't have the money, but it definitely helps you. And at the end of the day, if you take these couple steps proactively, just build into your process, we found that it just really does help with long-term performance of your portfolio.
Absolutely. And I would even say making sure that up front you've got policy restrictions on collateral and the type of collateral that you underwrite. So I think that's a big factor as well.
Yeah, I think, I do feel like most of the dealers that I speak with are generally long-term thinkers. And that's why they like, consume this type of content and because they actually care. There's always bad apples in every bunch, but I think those dealers do think about like, hey, how can I, make sure that my portfolio with, X lender is great for many years to come. And so my business thrives because at the end of the day, as a dealer, if you can't lend, if you don't have the right lending partners, lending relationships, you're not putting any car on that road.
That's
Or
right.
very few.
That's right. Yeah.
So transitioning, you mentioned EVs. When it comes to quantifying the risk on EVs versus, internal combustion, like how are you doing that right now?
So we're still early in the game. So I think like everyone else, we're working through the risks. Clearly battery life is a concern. The cost to repair that vehicle once the battery goes may or may not be worth keeping the vehicle. To the extent we lease EVs, there's obviously a potential impact on residual values. So what we're seeing, currently is most of our EV volume is with prime customers. The typical auto loan will cycle off in about 2.5 years. And EVs are still relatively new to the market. So I don't think we're at that point in the life cycle of EVs that it's an imminent concern, but it's definitely something that we continue to monitor. We currently don't have any specific policies or restrictions related to EVs, but again, it's something we monitor as we start to see the EV units in the market start to age. I think that's something that we're well aware is going to bring its own risk, and we'll continue to assess and adapt.
Yeah. I mean, to me, assuming there's some greater level of dispersion and value of, a 10-year-old EV versus a 10-year-old internal combustion vehicle versus what we know today, it feels like there's an opportunity there as well, right? Whoever can properly assess, the risk on that collateral and that loan, feels like nowadays it could just be a really big competitive advantage when everyone is, it feels like scrambling in a way or not exactly knowing how aggressive to be when putting out a loan for an EV. That's awesome. Going on the lines of, you mentioned earlier collections and repos. So back on that line for a second, right? Tell us a little bit about just like the nitty gritty of that side of the world. Like, what does your recovery network look like? How do you locate a vehicle? Like, how does all this actually work behind the scenes?
Yeah. So we have a network of forwarders that we use. And just thinking back to my Chrysler financial days, I think back in probably 2008, 2009 is when a lot of lenders started to move into that. And part of it was just the complexity of managing a gigantic vendor network across all states. So, we do have a network that we use. As I mentioned, we typically like to work with the customer. We don't want to repo a car. So we will, we have active outreach programs, whether it's calls, texts, making sure that we've given the customer ample opportunity to ask for help and really, work with us. But then unfortunately, we know that sometimes repo is the only option. So, in that case, we do try to, as you mentioned, recondition the car, make sure we're maximizing the value. And then working with our forwarders, providing whatever information we have in terms of last known address, other tools that we use to try to locate the customer. And then, it's the typical industry tools that the repo agents will use, like the license plate recognition. And then typically, once we assign a car out for repo, our average time to recovery is about 10 days.
Oh, I mean, sounds quick to me. You mentioned like resources working with the customer. I think that's a really important point to hammer because, I think some people out there think that, customer may kind of fall into some financial issues, some time passes, car disappears. But what you're stating is really important, that, you like you mentioned, you have outreach programs, you work with customers, there's resources, right? You're really trying to mitigate this. When it comes to like trends that you're noticing with fraud, or is there anything, it was specifically with respect to repossessions, are you noticing an uptick in any forms of fraud leading to repossessions, or is there something that's happening right now that you're noticing in the economy? One more thing to note there before you respond. I recently had a guy named Frank McKenna on the podcast from Point Predictive, which is like a fraud analytics, or they do a lot of different analytics and technology for the industry. And he was just talking to us about all the new types of fraud that are arising because of just the situation, the kind of the macro situation that led us to this point in the economic cycle. So I'm curious, from your perspective, I see you nodding. What are you seeing when it comes with respect to fraud and repossessions?
Yeah, I think, when we think of fraud, or at least, traditionally it's kind of bad guys trying to, get cars. But what we're seeing now, I think is very different. It's a product of the macro environment where, you've got customers that are just stuck, and we're seeing bad payments to avoid repossession, quick pay downs with an attempt to trade the car. So I think it's, we're seeing a lot more uh, impacts of the economy and just desperation versus, like we've all been familiar with fraud rings in the past, where it's a little more organized. I think now it's just a sign of the times and the challenges that we're seeing in the economy. Um, and then the other trend I would say is, as you move to digital and online, you start to see more synthetic IDs. I think that's one thing that I love about the dealer model is the customer goes to the dealer, there's an actual human being there, and they can verify their identity and look at their driver's license and make sure they're in fact a real person. So I think, as we start to move more to digital, that's something that we're going to have to be proactive and be able to solve for. Right now, even in the digital channels that we participate in, it's still typically a dealer delivery, but I think in the future we're going to see potentially some contactless delivery, and that's where I think there's a big propensity for fraud.
Yeah. So, and you have a partnership with AutoFi, I believe, right?
We do.
Yeah. So AutoFi is actually a partner of the podcast. So shout out AutoFi. But tell me, how do you balance that, right? What you just mentioned, like how do you balance going digital, right, and working with great companies that are in the digital lending space, or helping get a more online sale and lending facilitated for customers, versus what you just mentioned, right? Being physically at a dealership, having a human, confirm the identity of someone. How do you balance those two things?
So I think our approach, at least in the short to medium term, is to continue to leverage the dealer network. We are an indirect auto business. We rely on our dealers heavily. We view our dealers as our customer, and we see them as integral to the car buying process. I know other lenders have tried to do direct to consumer. I worked for one. It was very challenged in that, you're spending this money up front to market to the consumer and have your own sales team talking to the consumer, pull a bureau, do a decision, structure that deal, only for the customer to go to the dealer. And then you see that same loan come through and fulfill on your indirect channel. And in that scenario, there was a dealer compensation component, but still it ended up flipping to the indirect channel. So the approach we're taking is to partner with our dealers, but to give the customer the opportunity to be in the driver's seat, no pun intended. To me, those 2-3 years during COVID, I saw a lot more movement to digital than I did in my entire career. So I think we need to piggyback off of that. I think the consumer wants to be educated. They want to be able to shop for the car. They want to be able to understand what they qualify for, what their payment's going to be, and feel like they're in control of choosing their financing. So what we've built with AutoFi is our Drive US platform, that we're currently piloting in Arizona and in Texas, and it lets the customer do just that. But we've also piped in to our dealer network and dealer inventory. So essentially, here we're working with our customers and letting them shop for their car. Understand what payments they can afford. They can shop by payment, they could shop by unit. But then also this helps our dealers because we're helping generate leads on that side as well. So, maybe down the road, there is a model where the dealer's not involved. I don't see it. in the near term. So we're continuing just to leverage our dealer network, but then also give the customer some options.
Yeah. Do you think there's any embedded just advantages when you're like a vertically integrated player, like let's say Carvana, right? They have their own lending arm and whatnot. So do you think does that just offer like an embedded advantage where you maybe have some more like fraud mitigation and it's easier to do the online transaction? Or do you think that ultimately gets commoditized across the industry and every dealer can, sort of operate to those standards, in an online way? What do you think about that?
Yeah, I think it's the latter. I think where, the auto industry, once somebody figures it out, others quickly, follow. So I think, to the extent that they can, find the secret sauce to fully preventing fraud, I think, I think you're going to see other lenders or other OEMs, dealers, lenders quickly piggyback on that. But I think that the challenge when you're operating vertically is you still have to have lender partners. You're still going to need access to capital. It's cyclical. Maybe you excel in a certain area of lending, but I think you still need a partner that's complementary. So even where you see some of our other partners, whether it's national accounts or other auto, like CarMax is a great example. They have their own captive, but they also have lender partners. It's just a matter of having options and having partners that are complementary, where they may excel in an area where you don't, and vice versa.
Yeah, I totally agree with that. I think no one balance sheet wants all of the loans and all of that risk. Everyone has different preferences, so that makes total sense. You mentioned being able to deal with all types of loans. So I thought there I had is, what do you do with all the loans, right? Like you underwrite, you then create all these loans. What do you actually do with them?
So the loans sit on our balance sheet, and we service them. But we are also the second largest issuer in the auto ABS market. So
I did not know that.
Yep, we are the second largest issuer. So so check us out. So that gives us an option.
We have a ton of investors and like hedge funds that listen to this, so that's actually a good plug.
And I would hope they're already familiar with us, but if not, let me know, and
yeah,
we
I'm
can
sure they
get
are.
in touch with the right people here. But yeah, so we will sometimes securitize the loans to raise capital. It's just an efficient way of funding for us. So we pledge the loans, but they still sit on our balance sheet, and we still service them.
Mm-hmm. But do you keep some? Do you like sell? Like, how do you decide what to keep versus what to sell and all that?
It just depends on the time and the market and the pricing. We've got alternate sources of funding, so it's just a matter of balancing. So if we want to go to the capital markets, but maybe the pricing isn't right for the time, we can not wait and sell it another time, or seek alternate funding.
Yeah. So this question is not exclusive to Santander, but just being in the position you're at, right? A lot of dealers are saying, "Hey, like my bank fees or acquisition fees, right? When I'm doing a loan with a subprime customer, I have to pay an acquisition fee to the lender, and that's to reduce the loan to value and reduce the risk, right? That's a very simplistic way to put it. But lots of dealers are saying, hey, my acquisition fees are rising, LTVs are dropping, right? I'm having trouble getting customers approved. Like, what's the explain to us, like to me, like a third grader, like why is that happening? What's happening behind the scenes that's leading to that?
So, in terms of structure and credit, I think that just comes down to affordability. We did not get aggressive during the pandemic when times were good. And, we don't want to be aggressive now either. So we want to make sure that, like we talked about earlier, that we're assessing at the individual level, not the portfolio level, that the customer can afford that loan. So I think that's the first piece. Then in terms of fees, if you think about the subprime customer, the prime customer is going to feel the increases of the interest rate environment, because they're used to 2, 3, 4% interest rates, and then you see the interest rates going up. If you're a subprime customer and you're already at the maximum interest rate for your state, we can't price that loan any higher. But with our cost of funds
The
increasing,
money's got to come from somewhere.
it's got to come from somewhere. So our cost of funds has increased. We need to price for the risk of that loan, the cost of servicing that loan. And so to the extent that we can't make up that margin and price for the risk and price for the servicing, that's where, we may introduce that as a fee, or in some cases, cut back the structure to reduce the risk of the loan.
And when it comes to the macro, like with interest rates being where they're at and spreads as well, can you talk to us a little bit about that? Like, how does that impact your ability to then sell off some loans where the market is maybe pricing these bundles differently than they would have 2 years ago?
Yeah. So fortunately, we've got a fantastic treasury and securitization team that handles the details of that. But, basically, they go to market and they'll price a deal, and they take the judgment to decide, do we want to place that loan in the market, or is this not the right time? We seek alternate funding sources. One example of a funding source we have for our prime loans, we leverage our bank balance sheet. So Santander Bank North America, we do originate loans on their behalf. So we have that as an option where we don't have to sell these loans. We put it on the bank's balance sheet. And this would be where our prime portfolio sits.
So before we get to the macro, I want to backpedal for 1 second. And earlier you were talking about like the physical in-person customer being at the dealership and how you love that from a verification standpoint. What about internally when it comes to your underwriters, right? Your actual team. How much of that is still being done by humans versus like computers, machines behind the scenes? What's the difference there?
So we've got a very automated model. And I've worked for 3 different auto lenders, and I would say by far, I think we have the best model. We have a decision engine that will run, and it will assess credit. It will pull the bureaus. It will run your know your customer, the KYC in the background. It will run OFAC, and it will price the loan. This allows us to send a decision to the dealer within seconds. And so I'm sure it's very important that you get a decision right away. If it's too long,
Absolutely.
then you're not even in the room. Other lenders I've worked at we're probably in the 75% automated, where 25% goes to an underwriter, best case. So this is fantastic, but does it take away the need for underwriters? Absolutely not. We will still see about 20-30% of our applications where an underwriter actually touches them and works with the dealer. Now, we do have a dealer portal that we use. It allows the dealer to be able to go in and make small changes to the application. They could do rehashes within policy, which is fantastic. It's great during busy times. It's great after hours, weekends, although we are open. But there are just times where the dealer needs to talk to an underwriter. They may not understand our program. They may ask if we can make a pricing or policy adjustment, or just have to have general questions about the loan. So I think our model is great where it leverages the best of automation, creates consistency, but also gives the dealer the option if they want to go self-serve on our portal for something simple, they can do that. But if not, we still have a team of underwriters that is here and ready and able to help them. I still think this is a highly relationship business, and we want to keep it that way.
Are you hiring?
Send me your resume.
Not for me, but no. But you know what we'll do though? We will put your link in the show notes. So if you are hiring, I'm sure lots of you are listening here are, like I said, are in the industry and on the lending side. So maybe we can get something lined up there as well. Transition to macro, right? Like, what's your outlook here for the next couple of years? Are you preparing for quote unquote higher rates for longer, or how are you thinking about all this?
Yeah, we are. We are preparing for higher rates for longer. We obviously very closely watch Fed movement. Right now it's not looking like we're going to get any relief until, I don't want to misspeak, but sometime mid next year, and it's not going to be a drastic drop. So it's going to take time. So, we consider this when we plan our volume, when we plan our profitability. We run various scenarios just to try to be ready for each scenario. What we don't want to do is something unnatural. I'm very fortunate that leadership here has been in the business a long time, and they understand that there's cycles. So we're not going to do anything unnatural. We're not going to do anything aggressive to try to manage the cycle and force some profitability or some volume that's not there. We're going to stay the course and continue to do what's right for our customers and our dealers and our shareholders.
Yeah, sounds like a prudent strategy. So you're in survive till 25 camp.
Yeah, and sometimes you just gotta make it through the bad. We made it through the good times, and now we got to make it through the bad times. Like I mentioned earlier, we did not get aggressive during the good times and try to overcapitalize on that, which would then introduce risk down the road. And we're not going to do anything aggressive in this cycle either. We just got to stay the course.
So, Betty, we're about to wrap up. What do you have to say, like, to dealers in general, like from your perspective, like what's going to be important, or how are you thinking about the environment that we're entering or that we're already, within, and just, as a dealer performing, for consumers, right, getting those loans to perform, like, how do you think about all that?
Yeah, I, like we talked about earlier, this is a cycle. We've all been through them. We had a great cycle, and now we're facing some challenges. I think we need to just stay the course. And I think what's really important for us internally, as well as for the dealers we do business with, is to have a strong control environment. We find that our best dealer partners have a strong control environment. It helps prevent fraud. It helps prevent income inflation, power booking, and consumer harm in general. And it helps our partnership. Dealers need lenders, and lenders need dealers. And I think this is something we can do to help each other till we come out on the other side of this.
Yeah, it's good advice. And I think that, there isn't like one silver bullet when it comes to controls from my experience. I think it's a combination of a lot of different things, especially at the dealership when you have, some people rotating seats, they come with different habits. So we always found, my 2 cents at least, it's just, if you set very clear expectations up front, and make it very just abundantly clear, like these are like your standards, you don't deviate from them under any circumstance, and you're kind of thinking long term, most people will do the right thing, and they'll sort of adapt to the way you operate in whatever business. Some people won't, and those people don't last, but I feel like most people really do want to do the right thing when it comes from the top. When it doesn't come from the top, that's a bit of a different story. So
yeah, in my experience, I haven't met a lot of bad dealers, but there may be bad actors within the store. It happens. And so having that strong control environment to be able to detect it, prevent it, that's key.
Awesome. Betty, this has been an incredible conversation. If anyone wants to learn more about you or, Santander, positions at Santander, working with Santander, where can they go to learn more?
They can go to santanderconsumerusa.com.
Amazing. And we'll also put the link in the show notes below with your info and the website. Betty, that's all I got for you.
Okay.
Awesome conversation.
Thank you so much for having me. I appreciate your time. And thank you for all the dealers that do business with us. And if you don't do business with us, come check us out.
All right. Hope you enjoyed that episode. Please give the podcast a rating, consider subscribing to the show, and check the show notes for links to what we talked about. Thanks for tuning in. I'll see you guys next time.